Right. Hello. This is Alex Piroglu, and this is a very quick video to share some thoughts on the bond market. Um, I will make this very quick. I won't share the full set of data I'm looking at, whether from intermarket, macro point of view, or technicals, but just three and a bonus reason why I think the late October bottom in the bond market has legs to it, which I think was, sort of like the bottom or the top for yields, depending on which chart you're looking at. Right. So the first piece of evidence I would like to present with you, as we saw in the past couple of days, the bond market has what we've seen actually here is the 10-year Treasury note futures have made a break from the above the 200-day moving average, 200 bar moving average. Um, of course, someone may ask, why is that a valid break, signifying something bigger at large, a trending change, and not a repeat of the March to May situation when the bond market, the treasury note market, broke 3 or 4 times and then it collapsed. Basically, had a false breakout. So why is this valid and not that in that situation? So the first reason is of a technical momentum reason. Now, the indicator at the bottom panel is the MACD, and as we can see, the breakout is accompanied with a break of the 100 level for the MACD. Now, this is a little pattern I have noticed over the years I've been using the indicator, is that 200-day moving average breakouts that are accompanied with equally strong momentum, i.e., the MACD being above 100, usually makes add some validity to the break, something that we did not see during this period. I mean, the market was breaking up and above and below, but the MACD never got anywhere above 100. It was always near the 78, 75, 73 level. And during the last breaks, it actually even diverged. The indicator was below 50. So that's the first reason. The second reason, which I think is even stronger, but combined with this, add things up. The This 116 level, as it happens to stand today, is a new momentum high for the past 3 years. The last time the MACD got this high was when it got in the beginning of March 2000. So that's 3.5 years ago, and that actually marked the top for the bond market. It got on the at the risk level and marked the top. Ever since then, during this bear market, the momentum highs that we saw were in August 2021, and since then the market has never gone above the 100 level. So now that we're seeing a new momentum high for the past 3 years, I think this makes the breakout valid and something to be watching out in the future. Again, it's a momentum pattern. Of course, I wouldn't be trading this on its own, but unless I've got other stuff. One more thing I've got, so please allow me to collapse this panel. The second thing I've got is a chart of seasonality. The seasonal trend for the bond market. Again, two pieces of evidence from a seasonal point of view is, first of all, the bond market since um, October, when it traced out its bottom, has been moving counter seasonally, which means it's been stronger than its seasonally bearish period, which that is also very shows underlying strength. But right now, it will have the seasonal backwinds, a bullish seasonal backwinds, as seasonality usually bottoms out around late December and is positive into the beginning of February. So from that point of view, we have another factor highlighting that this actually may have legs. It will prove to be more than this bear market rally. And the bonus reason is that since yesterday's Fed meeting, um, as from what we understand, the Fed policy might be reversing in the coming year. And historically speaking, since the 1970s, before rate cuts, changes in policy from into rate cuts, the bond market has always rallied ahead of that. So if this is to play out like that, um, this particular bond rally may actually be part of that historical tendency for the market to be rallying before the actual rate cuts. And with that, I would like to thank you very much. Of course, there are other pieces of evidence we could provide with that from a sentiment, commitment of traders point of view. But I will leave you. I will just share these thoughts with you. Thank you very much.